Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his good friend, Mr. Dan Bird. How you doing, sir?
I'm doing well. How are you?
I'm doing well. So you had a call last week that caught me by surprise. It was one of those times in my life where I got to sit back and really think about this, and I came ready. So, folks, he has a playlist on this channel. It's just called Dan Bird. You made a call
No.
that potentially the S&P 500 could close the year at an all-time high, which again caught me by surprise last year because that's not what I see coming in the economy. But again, the stock market is not the economy. So I wanted to poke at this a little bit. I wanted to share some of my thoughts about.
Wait. Did I say that?
I think you did. Yes. I think you did. I think I have a video.
I guess it's on tape. Huh?
Yeah, it's on video. I can go back and play it. And you did
Darn.
say might be at an all-time high.
I always use the words might and may.
Yeah, exactly.
In my conversations.
Smart man. But I just want to poke at that a little bit. Again, it's not your call. It's just something that caught me by surprise because I see a lot of tripping hazards.
Can we put my newsletter up real quick?
Oh, yes, please do that.
Just so people know if they're interested in joining and getting the newsletter each week. It's free. No cost to it. I just do it for myself anyway. So I send this out usually on Saturdays. It's got some cartoons. Some people just like the cartoons. By the way, a lot of people might not make it all the way to the end, but there's a list of book recommendations at the end of the newsletter as well. Yeah. So if you want to, continue learning about the market, there's some good books that I've read at the very end of it.
Yeah.
So anyway, breakpointtrading@gmail.com. Just send me an email and I'll add you to the list. If you ever want to be taken off the list, that's no problem at all. I'll just remove you. No big deal.
Yep. Again, this is something I look at every week. It's something I'm reading because I want to be a better trader. I'm an emotional investor in the stock market, which usually is a bad thing. So you're helping me kind of remove that. So this has been very helpful every week. But back to kind of the topic at hand, this all-time high. There's a couple of things I've been sharing on my daily financial news that I want to see if you agree with, or you're like, I don't see it. So do you want to keep this up, or do you want to stop sharing?
It depends on where you're going to go, but there's one particular chart that I want to be up because it's really important.
Okay. Yes, I know this one.
It's this one.
Yeah. So again, we're talking about the end of the year, which is now 7 months away, right? We're at the start of June. And I think the first part of this year has been multiple compression. I believe the next 6 or 7 months are actually going to be earnings cut. I think we have started pre-announcement season. First was Snap, then was Microsoft. I think more is coming. So as I look at the next 90 days, it's earnings cuts. Then I see kind of consumer confidence. The consumer is 68% of the economy. I see them backing off. I think they have one more blowout party this summer, then the consumer retreats. And again, the stock market is not the economy. The economy is not the stock market. I get it. But I think there's a lot of things that the market is not looking at right now that I think is going to drive earnings down into a compressed multiple, which means the S&P can't get back to an all-time high. I just don't see it, at least this year.
Well, that may be true.
It might be true, Michael, but it might not be.
It might not be. It might not be true.
No, of course.
And remember what I said last week was if the CPI report comes in higher, we're probably going down.
Right.
If the CPI report comes in lower and it continues lower, confirming the trend on inflation, I think we're going to get back to the all-time high.
So I just want to play that out because I think that's an important thing. Basically, what you're, again, in your may, in your might, in your coulds, really your anchor is we have seen peak inflation and the drop in inflation accelerates. Just as it accelerated up, it'll accelerate down. That's kind of the anchor of your idea.
That's part of it. But this chart you're looking at right here is my overall anchor for long-term trading and investing.
Okay, so tell people what they're looking at. It's in our playlist, but they may not have seen this one.
Yeah, this is real, and a lot of people forget that I've shown this, but it's a really important concept to understand. These are the secular bull markets going back to 1929.
Okay.
And everything that's in red are secular bear markets.
Okay.
Secular just means long-term, means extended.
Okay.
All right. Cyclical, on the other hand, either bull or bear, means a short-term correction. So if we look at let's look at this middle bear market right here. This is from 1969 to 1981, all through the 70s, stagflation in the 70s. Okay. So the market came down, went back up, came down, went back up. It never broke out of the high until 1981. And that's when a new secular bull market began, because it broke out of the high and it never really went sideways again. It just continued up.
Okay.
Now, inside of these secular bear markets, there is, in this case, there are two cyclical bull markets. All right. So you still could have made money in the market during this period. If you'd got in 71 and stayed in until 73, the market had a huge run during that period. But it never broke out of the high. It came back down, actually lower than that previous low, came back up and didn't break out of the high until 1981.
Okay.
Same thing over here, the 1929 crash, and this is the Great Depression in through here. Market never really broke out until 1951, and then it went on a secular bull market. Secular bull markets have cyclical bear markets inside of them. Okay, so you can see some right here. But in general, the trend is higher. So these cyclical bear markets don't pierce the low, the previous low. So the bull market continues higher. These secular bull markets typically last 18 to 20 years. It's important to understand that, as we are in another secular bull market right now. And if you look at the times when it's come back, right there, and here's the COVID crash right here. In the overall trend of this bull market, it's just a blip. Over here in 1987, we had the 1987 crash. You can see it right there. Yeah. Everybody thought the world was ending in that 87 crash. The market went down something like 50% in a couple of days, right? But in the overall bull market, secular bull market trend, it's just barely a blip. Okay. So this really is my anchor. We are in a secular bull market.
And again, your secular bull market really means, I think you said 18 years, 15 to 18 years?
18 to 20, 18 to 20 years.
And how many years are we into this?
This one you could measure, depends on how you measure it. You can measure it from the low, which was 2009, or you can measure it from the breakout above the previous highs, which is 2013, which is really probably the correct way to measure it. So 2013 or 2009, 2013, 20 years would be 2033. 2009, 20 years would be 2029. So we have 7 to 10 years left in the secular bull market. And if we get a continued correction down to 3,500, it will just be another blip in this overall upward trend.
And I think I asked you this one time, what is there a number if it got so low that this bull market would be over?
Right. So here's the chart for, this goes back to 2009. So this is the low in 2009.
Yeah, the first one.
2013 breakout would be right about in here. All right. But if we look at the low in 2009 and draw the line across the lows, we'd cut through this COVID crash because it didn't last very long.
Yeah.
All right. Then that puts us up around 3,000. So this secular bull market can continue even if the market goes all the way down to 3,000. We will still be in the secular bull market.
Got it.
Okay.
Yep.
I don't think it's going to go that far. It could get back to the previous high just before the COVID crash. And that's 3,400.
Got it.
All right, which is 10.5% below the low that we made at 38.50. And right now it's probably more like 12%.
Sure.
And if we continue higher, it's going to be, just
farther and farther
increasing.
Away. Yep. Okay.
But it's just as likely that we've seen the low already and then we're headed back up.
Yeah.
Now,
which is crazy to think about, but yeah.
Yeah. So the high was 48.18. If we get successively lower inflation numbers the next 2 months, confirming the trend and confirming acceleration, then I think the market takes off. Remember, the market is 6 to 9 months ahead of the economy.
Yeah, totally.
So when you talk about things like reducing earnings and companies going bankrupt, that kind of thing, that's the economy.
Correct.
The market already knows that's going to happen.
Got it.
It's already priced that in. That's what brought us to 38.50. It's already expecting that.
Okay.
If inflation continues higher and the Fed goes to 75 points, that's going to be a surprise.
Right.
And that will push the market down again to the 3,500, 3,700 area. But even if that happens, let's say that happens next week after the CPI report.
Sure.
Let's say we get down to 35 or 3,700 in the next week or so.
Okay.
The market will have already priced in all of that negative news.
Okay.
All right. So that's what the market does. It prices things in ahead of time.
Yeah.
And that's the thing you have to understand. You can't say, well, the economy is going into a recession and everything is bad and companies are reducing their earnings. Yeah, the market already knows that. Yeah. It's already priced that in.
Yeah, this is why I have not been in the market for 15 years because I can't get away. I can't get out of my own way.
Right. Yeah. But you cannot predict the market.
No.
That's why I use terms like might and may and could.
Yeah, of course.
Because you don't know. I mean, it could get down. It could go to 2,500. Who knows? Could go all the way down here to 2,400, which is support down here.
Okay.
If that happens, then the secular bull is over.
Sure.
And we're back into a bear market, a true secular bear market. Right now, we are in a cyclical bear market.
Understood.
We are in a short-term bear market that's inside of a long-term bull market.
So let me pivot on this. And if you want to stay on this chart, it's totally fine. But let's talk about a recession. I think there's a lot of folks, myself included, that thinks a recession, an official recession, 2 negative GDPs, will happen sometime between now and a year and a half, somewhere, right? The soft landing idea is a joke. So people think a recession is coming. What you're telling us here again is that the stock market kind of expects that and prices it in early.
The market will price it in early. I am not convinced the market is pricing in a recession yet.
Okay. Well, that's interesting.
I'm not convinced of that.
All right.
So I did a little bit of research, and especially with something one of your listeners said. I don't listen to all of your podcasts, but every once in a while I will.
It would be hard to listen to all mine.
yeah, it would be, unless I had nothing else to do.
Yeah.
But one guy you talked to you were talking about recession, and he said, yeah, recession typically lasts 2 years. Well, that's not true. Yeah. Recessions don't last 2 years.
Okay.
Recessions on average last about 11 months. And I'll show you something that proves that out.
Yeah, but also my research, just because I've said it before, is the average recession is 17.5 months is what I've heard. And maybe that includes the 6 months of the call. But anyways, let's take a look.
I'll show you the actual numbers.
Sure. I look forward to it.
But at any rate, a recession historically has been defined as 2 consecutive quarters of decline in GDP. And that's an easy way to call a recession.
Sure.
However, a more modern definition is a significant decline in economic activity spread across the economy lasting more than a few months. Spread across the economy.
Yeah.
So it has wide breadth. It's not just one sector.
Area. Correct.
Right. All right. So that's the modern definition, but 2 quarters of GDP is a lot easier to count.
Exactly. And it's historical. Yeah.
Right. This is an Investopedia, by the way, which I love. I highly recommend any of your listeners, if they ever have a question about the stock market or any other investing type of platform,
for sure,
go to Investopedia and search for what you're looking for. I just searched on length of average recession, and I got this article. So here's historical recessions. Here's all the recessions. Right? This describes each one, why it happened, how long it occurred.
That's awesome.
Et cetera. Right? So these are all the recessions. And then this chart right here, I've actually put into a slide because it didn't include the 2020 recession.
Oh yeah, the 7-second recession.
Yeah, the two month recession. All right, so these are the numbers. This is the empirical data.
Okay.
All right, so these are recessions all the way back to the Great Depression. So what I did was, and I added in the COVID crash up here at the top.
Sure.
So this was the length of recession was 2 months. The bear market lasted 2 months. Right, so bear markets you don't always have bear markets and recessions in combination.
I see what you're doing. Okay.
Right, sometimes you have a bear market and not a recession.
Sure.
Right now we have a bear market and not a recession.
Correct.
Right, so just because the stock market is in a bear market does not mean the economy is in a recession. Okay, but these are the official recessions, the ones that were officially were called. All right, this is the financial crisis here is 18 months, was the longest one other than the Great Depression.
Yeah.
And if you add all of these up down to the Depression, if you exclude the Great Depression, then the average length is 11.1 months. Average length of a recession.
I understand.
If you include the Great Depression, then the average length is 14 months.
Got it. Okay.
But in modern times, a recession typically lasts about 11 months.
Now, just so I'm clear on how these numbers, so again, the 11 months here, does that include the 6 months that you've already counted, right? You've had 2 quarters of negative growth, or is this 8 months after that's been called?
Yeah, so that's a good question. Typically, we haven't had 2 quarters of negative growth. That's what makes.
Yeah, of course. That's why
we haven't had 2 quarters of negative GDP.
I understand.
That's what defines a recession.
I understand, but that's why I'm asking you. Let's say Q2, this that we're in right now, magically negative 1%. So now we have Q1, Q2, 2 quarters. So congratulations.
Then based on that original definition, we would be in a recession, but it would not be called. This is an important thing to understand too. The company that calls the recessions, I can't remember what they're called, but it's actually in that article.
Yeah, I'm just trying to figure out if the 6 months that we just
the NBER, National Bureau of Economic Research, they're the ones that call a recession.
Yeah, no, I understand.
And this is the reason why a lot of people think that recessions last about 2 years, because they don't typically call the recession until 8 months after it's over.
Exactly.
Okay.
Yeah.
So you could have a 6-month recession, and it gets called 14 months later, and you think you've been in a 2-year recession.
I got you. Okay.
All right. So this, even if the next GDP number is negative, between you and I, we can say we're in a recession.
Yeah.
But the recession won't be officially called
for quarters,
probably for 6 more months.
I agree. Yeah.
So
yeah, economists
those
only look in the back rear view mirror. That's what they do.
Right. So the answer is no. This does not include the current one because this hasn't been called. It's not an official recession.
Right.
Even the COVID crash, it took them until almost the end of 2020 to verify that it was a recession and call it a 2-month recession. So keep this in mind. Now, going back to the secular bull market, and I should have highlighted it here. I didn't do that. But secular bulls were, so this one here, this 8-month one was inside of a secular bull market.
Okay.
This was a bear. This was the end of the bear. This one was the end of that bear market. That's when the secular bull started in '82. This was a bear market. This was a bear market. So most of these were in bear markets.
Oh, interesting. Okay.
Except for this one. Right, this one here. That was only 8 months. So in secular bull markets, you rarely have a recession, but if you do, it's usually very shallow.
Got it.
So if we get a recession, it's not going to be a long one. It's not going to be a 2-year recession.
Assuming
if we get a recession, I think it will probably be the beginning of next year. I think we might still hit an all-time high on the stock market. and then we might get a recession. The stock market will come back down again.
Okay.
But that recession, I don't think is going to last very long.
Okay. Yeah.
But I could be wrong.
Of course. Yeah. This is all just your crystal ball is as broken as mine.
Don't make investment decisions based on what we're talking about.
On some pretty charts. No, we're just trying to learn, trying to get a little bit better. Any kind of closing thoughts? Where would people get your newsletter if they want to read what I'm reading?
Sure. I'm going to put this in the next one, by the way.
Yeah, I think it's a good
chart.
idea.
I just did this morning just for our conversation.
Thank you. There you go.
I like doing research. I like looking at history, historical trends in the market.
Yeah,
because history can really help you history can keep you from panic. Yeah,
and that is something I need as an emotional trader. So if you want to get what I get, it is breakpointtrading@gmail.com. It's a good read. Usually comes on Saturdays, sometimes on Sundays. It is free to get on and free to get off. Dan, thank you very much.
You bet. My pleasure. Take care.